Hello everyone, how are you doing? As many of you requested for the video lecture, so I'm recording this lecture. Hope you will find it useful. So in this chapter, you will basically learn accounting for lease contract for a state or local government, and you will also learn how a local or state government recognize the liabilities, and especially for their closure and post-closure cost-related liabilities. We will also learn a little bit pension liabilities and how they record the donation and acquisition of works of art and historical treasures. So first we're gonna focus on the lease contract. Like for-profit businesses, state and local government business also lease property rather than purchasing it, because sometimes they will find that lease probably will provide them with lower cost, and also it reduces the risk of obsolescence and damages. So for their lease purposes, they actually can record it either as a capital lease or operating lease, and they actually follow GASB's statement number 62, which is pretty much same like FASB's rules. So here you will see all these four criteria to treat any lease as a capital lease. Any state or local government must need to fulfill these four criteria. Number one criteria is that the lease transfers the ownership of the property to the leasee by the end of the lease term. Number two criteria is that the lease contains an option to purchase the leased property at a bargain price. And number three is the lease term is equal to or more than 75% of the estimated economic life of the leased property. And of course, the last one is that the present value of rental or other minimum lease payment must be equals or exceed 90% of the fair value of this lease property. So just like the profit company, state and local governments also need to follow this criteria to record any lease as a capital lease. So now we will see some examples how they record it. So for capital lease, it's pretty much same what we just discussed, and government-wide statements, actually if we look at the government-wide statements, and they actually record it just like the for-profit company. They record it as an asset and the liability, and they actually calculate the present value of their future lease payments. So here if you take an example which is from page number 760 and 761, and the example says that the state or the local government, they are actually going to lease a truck, and the truck is for 8 years lease. The estimated life is 10 years, and they're gonna pay annual payment, which is at the beginning of every year, which is $10,000. Now, if they calculate the present value of this all future payment, then they figure it out. The present value is $58,680. So you don't need to calculate the PV or the present value. It's already given there, but you need to know the journal entry. So what should be the journal entry for the government-wide financial statements? And here we're gonna follow the capital lease. We will assume that the lease actually meets any of these four criteria that we just learned, and government is as the lessee. So first they will create these assets, which is equal to the present value of their all future payments, and they will also record it as a liability, and they call it capital lease obligations. And then what they're gonna do, they actually make the payment annually, and they make the payment at the beginning of the year. So here on January 1st, beginning of the year 1, they make their first payment, which is fixed, the installment $10,000. So these payment, they will just reduce a portion of their lease liabilities. So their lease obligation, which is a liability, it will be reduced by $10,000. Since liability is reducing, so they will debit it, and at the same time they are paying cash, so they're gonna credit it. Remember, they make the payment at the beginning of the year. So at the beginning of the lease contract, they already made $10,000 payment. Then at the end of their first year, they're gonna make their second year's payment. But remember, when they are here at the end of the first year, their liability actually reduced by $10,000. So their lease obligation will be now, after making this $10,000 payment, it will be $48,680. And of course, since we know the truck has a life, estimated life, which is here mentioned that 8 years, so we gonna calculate the depreciation expense. Now, what will be the journal entry at the end of the first year, or you can also say at the beginning of the second year? So first they gonna calculate this depreciation expense. So how they can calculate it? It's a straight line depreciation. So this is the total lease truck's value. If you want, I can show it to you if you want to see the calculation. So their depreciation will be the total value of the truck. Of course, we will consider the present value, which they actually gave it to you, $58,680. And then the life is also given. It's the straight line depreciation, which is $7,335. So this is the depreciation. So they need to record it. And the depreciation recording is just like the for-profit company. The journal entry will be depreciation expense debit, accumulated depreciation credit. And the amount we just got $7,335. So this is the straight line depreciation. Now what will be the next journal entry at the end of the year 1? Remember, at the end of the year 1, they're gonna make their second installment. And when they are going to make the second installment, their lease obligation is already reduced by $10,000. So they need to calculate out of this second installment, which is $10,000, what portion is their interest payment and what portion is they are giving to pay out their obligations. So let's do little calculations. So what was here on January 1st, their lease obligation at the beginning of the year? Lease obligation was the present value of all future payments, which is given here, $58,680. And on that day, January 1st, they actually made a payment. So payment made, which is $10,000. That means on that day, once they made their first payment, their lease obligation actually reduced by $10,000. So their remaining lease obligation is $58,680 minus $10,000, which is, you can figure it out here very easily, $48,680. Now, when 1 year just passed, you can also call it it's December 31st, they're going to make another payment. So this installment is fixed, right? This installment is fixed. Another payment will be made for their second year's installment. And again, it's fixed installment. They will pay $10,000. Now, out of this $10,000, they are paying interest. And the interest will be counted based on that remaining lease obligation. And if you read the page, it says that the interest rate is 10%. So the interest expense will be $10,000 and multiplied by 10%, which is, I'm sorry, it's not $10,000. It's actually the remaining lease balance, which is $48,680, and then multiplied by 10%, which is actually, will give you interest $4,868. So they are making a payment which is $10,000, and out of that, their interest expense is $4,868. That means the remaining they are paying towards their lease obligation. So after this payment, second payment, which they made at the beginning of the second year or at the end of the first year, the same, the lease obligation will be reduced by the remaining amount. So their lease obligation will be decreased by the remaining amount. What is the remaining amount? Let's see. The remaining amount, they've actually made the payment, which is $10,000, and by the remaining amount, which is $10,000 minus 4,868. That means if you do this little calculation, you'll find that this 5,132 they are making payment towards their lease obligation, principal payment. So here for the second journal entry, you have to reduce that part from their lease obligation. So the journal entry will look like this. Interest expense, just like other expense, 4,868, which we just calculated, and the remaining balance is actually paid to reduce their principal obligation or lease obligation, which is 5,132, and they are paying cash, so cash is reduced by $10,000. So this will be the journal entry for these government-wide financial statements. Now, what should be the journal entry if you need to do the fund financial statements? So, fund financial statement is quite different because, it actually focuses only on the measurement of the current financial resources. So, what they're gonna do, they will treat this lease actually as an expense. So they first will record this purchase of this asset as an expense. So they will show it like this: expenditure, leased asset, the entire amount, which is the present value of all this future payment, and then they will create this another account, which is other financing sources and capital lease, which will be credited by 58,000, which is the present value of their future payment. And then when they're gonna do their payment, they will again treat it as expenditure, lease payment, $10,000, and then they have to credit cash. So here, remember, they can either show it as a general fund, and or whichever government fund is gaining use of these assets or the obligation for this lease, they will record this following journal entry. So you see that here, general fund actually does not report it as a capital asset, or they don't record it as a liabilities. So those accounts are not current financial resources, nor are they claim to current financial resources. Instead, they are showing it as an expenditure, and this is kind of a different account. This is a different account that other financing sources capital is. So this is kind of a different account, a special account they create to reflect these transactions. Now, here at the end of the year, they will also make their payment $10,000, and they will show it, split it, the numbers are same. They will calculate the interest expense, which is just like same because their obligation reduced by $10,000, so the remaining was 48,680. They will count their interest expense here, and then the remaining amount out of this 10,000, they're gonna show it as they're paying another expenditure towards lease principal. Remember, there is no actual liability, so both they are showing it as expenditure, and cash is going down, so cash will be credited. And you also see that there is no depreciation entry because they didn't record it as an asset, so they don't need to show the depreciation. Now we will see one special case, and this case it's actually solid waste landfill. Many state and local governments, they operate landfills, and they actually, when they operate these landfills, and they actually provide a place to their citizens and their local companies to dispose their trash and other form of garbages and refuse. So government actually, they can report it landfill operation within their enterprise fund, and if they actually earn some fees from their users or the people of this community, whoever, or the companies, whoever are using that landfill. So then they can consider it as within their enterprise fund. And if this landfill is kind of considered as like public service, and the users, they don't pay any fees, then they have to report it within the general fund. So now we will see one example. So assume that one state or local government, they have a landfill, and this landfill is expected to fill like in 10 years. And then what happened, that the current cost for the closure, when the landfill will be closed, they need to pay that cost. And also it is like strongly required by the United States Environmental Protection Agency. EPA stands for Environmental Protection Agency, that after closures they also need to maintain, or they need to make some other payments even for an extended period after the closures. So that is called kind of the post closures expenditures. So in this example, it is said that the closure cost is $1 million and post closure cost is $400,000, and then they make the payment during the first year is $30,000. Now they figured it out that at the end of the first year 16% has been filled. So what should be the journal entry? Here you see their total cost. What should be the total cost? Here, if you want, I can show this little calculation. Let's show it here. I'll write it down separately as like solid waste landfill example, and which is from page number 763. So here, remember what was their total cost. Remember that total cost actually means total cleanup cost, their closure cost and post closure cost. So their total cleanup cost, it means closure, which is they actually mention it. It's actually their $1 million. So I'll write it down here. $1 million, and they also had post-closure cost, which is given here, $400,000. And if we add this, then it will be 400,000 or 1.4 million. Right, you can also call it 1.4 million. Now this is their total cleanup cost. Now remember the assumption here they made, that at the end of the first year they actually the landfill was filled like 16%. So they need to accrue that expense, 16% expense. So the total cleanup cost is 1.4 million. So if I do this little calculation, that means at the end of the first year they should accrue how much? It's 1.4 million times 16%. So if you do it, take your calculator, you will find that the number is actually 224,000. So this is their first year's accrued cost. So that's, they have to record it as an expense, and they will also reduce a portion as their liabilities. So here, if you see this example, they actually recorded it as an expense, that 16% of their total accrued amount, 224,000, and they credited it as liabilities. And when they make payment, they actually made $30,000. That means their liabilities kind of paid up a portion of it. And of course cash is going down, so they're gonna credit cash. Now what will happen in year 2? So if you read page number 764, they found that actually 27% of their landfill is filled, and they estimated that on the basis of like maybe some changes in technology or inflation or some other change, they figured it out that their total cost, one closure cost is here end of year 2 or end of year 1, their total cleanup cost, total cleanup cost is actually again their closure and post closure cost, which is they mentioned that 1.1 million is their closure cost, and they also mentioned that their post closure cost is 500,000 or 0.5 million. So total cleanup cost is actually 1.6 million. And they also figure out that the landfill is actually 27% filled. That means they need to accrue how much? 1.6 million times 27%, which is, you can calculate it, which is the obligation comes out $432,000. So they actually need to accrue this amount. So they will now calculate that number. Remember, this is their at the end of their year 2, based on year 2 at the end of the year 2's estimation. But initially they actually showed it that the obligation is 224, but the obligation increased because of this closure cost and post closure cost increase. So they will also increase that amount, so their liabilities and as well as they have to accrue additional expense, which should be the difference, right? Because at the end of the year 2 it actually increased. So now they're gonna show this extra amount that will be their new accrued expense, and then they have to increase their liability. That means if you subtract this additional portion, 432,000 minus 224, you will find it's $208,000. So now what they're gonna do here, if you see the second year, they showed it this additional portion which they didn't show here in their year 1. So they will debit this expense and they will increase their liabilities. And when they make the payment, this is straightforward. They will just make it. Their liabilities is reduced by 30,000 and cash is credited 30,000. So remember, this is for government-wide financial statements. But when they do the fund financial statements, things are pretty straightforward, because for these fund financial statement, they actually focus mostly on like current activities. So they will just record this $30,000 payment. So they will show this $30,000 as a their closure cost that they are actually making in both years, year 1 and 2, and they will also credit cash. Now we will focus on defined benefit pension plans for a state or local government. So many state and local government entities have defined benefit pension plans for their employees, such as school teachers and police officers. So pension trust funds are often set up as fiduciary funds to manage the money and the investments held to pay for these pensions. As fiduciary funds, these pension trust funds are not included in government-wide financial statements because it's the fund statements. Government-wide financial statements must now report a net pension liabilities if the present value of the estimated future payments that relate to the past work is greater than the net position of the pension trust fund, and that is a net pension liabilities. And GASB actually requires that in most cases, but not all, the present value of the future benefits is determined based on the estimated long-term investment yield for planned assets. That decision has created a significant amount of controversy because it creates a lower amount of reported debt. The components to be recognized as pension expense are the service cost for the current period, interest expense on the total pension liability, and projected earnings on planned investments. In addition, any increase or decrease in the liability caused by changes in benefit terms are also included in pension expense immediately. Our next topic is the recording of any art or any historical treasures. So for-profit company, there is a long debate how they should report this type of artworks or any type of like museum piece, either they buy or they receive as a gift. And state and local governments also face this type of issues or controversy sometimes. Should those type of art or artifacts or any museum piece or any historical treasures, should those be recorded in their financial statements? So certainly those type of artifacts have some value, but how could you determine the value? Although it is optional, and the basic rule Gatsby actually says that governments should capitalize their works of art and historical treasures and similar type of assets at their historical cost or the fair value of this donation. So this is your Gatsby's rule. So for their government-wide financial statements, they will record it as an assets, and they will also record the payment if they purchased it. Or if they donated, then they will record it as a revenue. But for fund financial statements, if the museum is kind of viewed as an enterprise fund, that means they actually charge entrance fees from the public, then they will follow the same rule. However, if the museum is reported within the governmental funds, any such acquisition is reported as an expenditure. So they will record it as an expenditure, and if they pay cash, they will also record it as the cash payment. But if it is kind of a donation, no entry will be made. Now, Gatsby also encourages that the capitalization should be occurred. That means all state and local governments should capitalize all those like artworks, artifacts, or historical treasures. But at the beginning I mentioned it's kind of an optional if any of these three criteria are met. So Gatsby says if any of these three criteria could be met, then it could be an optional thing. And there is the controversy because sometimes state and local governments can feel the pressure to meet any of these criteria. So criteria number 1 is that if that treasure is actually held for public exhibitions or educations or in kind of like research in furtherance of public service rather than in financial gain, or if it is kind of protected and kept kind of under care and preserved it, and it is also subject to an organizational policy that requires the proceeds from the sale of this collection item to be used to acquire another items for collection. So if any of these three criteria met, then this reporting is optional. Next, we will learn about the infrastructure assets and their depreciation. So infrastructure is defined as long-lived capital assets that normally are stationary in nature and can be preserved for a significantly greater number of years than most capital assets. So for example, we can say like newly acquired infrastructure assets such as roads, bridges, and sidewalks. So those are actually for the government-wide financial statements. Those are these type of infrastructure related costs must be capitalized at the historical cost, and capitalized means those should be recorded as an assets. But for fund financial statements, those will be recorded as an expenditure. Now, if you record it for the government-wide statements, if you record those as assets, so definitely you need to record the depreciation. But except for, of course, land, we don't depreciate it, but there are some other items like art or like any historical treasures, or those are kind of assumes kind of inexhaustible, then you don't need to depreciate it. And if you assume that the lifetime is infinity, unlimited, there is no defined lifetime. And then Gatsby also provides an alternative, the modified approach, which actually eliminates the need for depreciating qualifying infrastructure. of course, like some sort of assets that have kind of an unlimited life. Also, GASB also allows that if certain criteria are made, then you can also choose to expend some maintenance cost instead of kind of adding it as an part of the assets or capitalizing it. And addition, if any type of additionals or improvements are made, those must be capitalized, but the cost of this maintaining infrastructure in proper condition is, of course, expensed. Now we will learn our next topics, which is, now we will see the Comprehensive Annual Financial Report, or CAFR. So the government-wide and the fund financial statements are most often presented to the public as part of a comprehensive annual financial report. So that's the statement they prepared to present it to their public, and you all are familiar with. It's called CAFR. The CAFR also includes an extensive amount of information about that local or state government entity. So for every CAFR, there are 3 distinct sections. One is their management discussion and analysis, and this is required as for like supplementary information, and it is kind of considered as easily readable information, readable analysis of the government financial activities based on currently known facts and decisions and conditions. And then they also present their financial statements, and of course they have to prepare 2 sets of financial statements that you learned in earlier chapter. One is their government-wide financial statement, and another is their fund financial statement. And in addition to these 2 sets of financial statements, if they have notes, of course they will include those like other for-profit company. And if they need it, they can also add some supplementary information if it is required. Of course, it's other than their MD&A. That means whatever they didn't mention in their MD&A, they can report all those as kind of supplementary information. Now we will look at our primary government and their components of units. So in governmental accounting, reporting entities prepare CAFR, which is really very crucial. That includes their MD&A and 2 sets of financial statements. We just see that, and also some notes or any required supplementary information. However, the composition of that reporting entity must be identified. Normally, the reporting process begins with a primary government. So what the primary government, it could be a town or city or a state, and any reporting entity, whatever a city or town, any state or local government, that also includes, like, it also includes any type of entity, includes any activities, organization, agencies, offices and departments that are not legally separate from the primary government. They also need to include all those. However, there are some entities that are interact, like very closely interact with a primary government, with any town or city, but they are legally separate. So what they need to do for these type of cases, so if they have any type of entity, those are legally separate, but if there is any financial accountability, they need to include this. So now their legally separate activities closely connected to the primary government must be included if there is any financial accountability, and if they omit it, this type of financial statement would be misleading. Now we will learn about special purpose government. So we always think of like the state and local government, like such as like primary government, such as kind of any city, town or state, but there are some other special purpose government entities. So these type of special purpose government entities, they actually perform or carry out only one single function for the public. So one common example is public schools or public universities or colleges, water utilities or hospital or any public transportation service. So for reporting purpose, the question arises whether such an operation is truly a special purpose government or it's kind of a part of the larger general purpose government, such as a city or county as either a fund or a component units, or perhaps it is not a government, or we can also consider it as kind of non-governmental non-profit organization. So there is kind of a controversy. So now we will learn how merger and acquisition is recorded or treated for state and local government. So you will see that sometimes two entities could be merged. Sometimes you will see this type of combination. Realignment is really very common. For example, there could be a homeless shelter for a non-profit entity. Then any city government or any local government could take over the operation of that homeless center. So there are some conditions what you can call a merger and acquisition. So Gatsby says that if two legally separate entities are brought together to form a new entity and no significant consideration is exchanged, then you can call it as a merger. And a merger, you can also call it merger if one of those entities kind of ceases to exist. That means one entity is dissolved and another entity is continued. So, for example, the combination of two school systems might well make the criteria to be deemed as a merger. And when they do this merger, of course, the net carrying value for both entities, net carrying value of their assets and liabilities are combined together. And of course, there may be some consideration exchanged, but for you have to remember for profit transactions, usually if they pay more the purchase price of any other entity, what you learned in Advanced Accounting 1, if it is higher than the assets they are purchasing, then it will consider as a goodwill, the excess consideration or the excess payment. But here in government accounting, they actually consider this, or they report it as a deferred outflow of resources. So you see here in this chapter, basically we learned a little about calculations, only few journal entries. Those are mostly related to lease examples, and of course we have another example, solid waste landfill, and for some other criteria how they record it and what are the most specific most common criteria, especially for works of art and historical treasures. You just need to know all these concepts, and you also learn about the CAFR and the three parts, and you also learn about little about the primary government and special purpose government, and if there is any like acquisition and merger. So you can read the page numbers that I already mentioned in your exam study guideline, and you have a couple of chapter and problems, multiple choice question that will be on your exam. You can also practice those. I'll also make video solving a couple of calculation based problems, and if you have any question you can let me know.